Most beginners traders focus on predicting the market, when to buy or when to sell. But here is the truth. If you don't understand risk to reward ratio, nothing else matters in trading. It is not just important, it is the foundation of everything in trading. So stick around, because in this video I am going to explain to you step by step what risk to reward ratio means, how to use it, and adapt to your trading strategy. Welcome back, guys. In this video we are going to discuss risk and reward ratio, what it is and how to use it to your own advantage. So this is what we are going to discuss in this video. So let's get straight to business. What is risk to reward ratio? Risk to reward ratio simply means the amount of risk you are putting in and what you are expecting to be your reward. That is what risk to reward ratio means. The risk is the amount you are putting in. The reward is the amount you are expecting to get back from the market once the market moves in your direction, once the market moves in your favor. This is the risk to reward ratio. So let's say, for instance, you are putting in $1 and you are expecting $2 back from the market. Once the market moves in your favor, you are expecting $2, but once the market moves against you, you are risking 1 to target $2. This is a risk to reward of 1:2. This is a risk to reward of 1:2. So also we have a risk to reward of 1:1. This is a risk to reward of 1:1. That's to say that you are risking $1 to gain $1. We have 1:2, a risk to reward of 1:2. You are risking $1 to target $2. We have a risk to reward of 1:3. You are risking $1 to target $3. So anytime you are putting in 1, if you are using a risk to reward ratio of 1:1, anytime you are putting in 1, you are targeting to gain 1 back. So that is a 1:1 risk to reward ratio. We also have a 1 to 0.5 risk to reward ratio. That is to say that you are putting in $1 and you are targeting $0.5 from the market. So the best of all is a risk to reward of 1:2. Let's say, for instance, this is gbpusd. This is gbpusd, right? So this is gbpusd. Let's say, for instance, the market has been doing a lower low, a lower low, a lower high, lower low, a lower high, a lower low, a lower high. Then let's say, for instance, your strategy is just a break and retest, and you want to sell the market from this region once the price comes back into this region. So now you are using a risk to reward of 1:2. So now once the market enter here, it gives you a double bottom or whatsoever your strategy for entry is, your entry strategy. It gives you, then you will now enter here. So once you enter, you will now buy, you will sell at this region. You now put your stop loss. Let's say you are selling this gbpusd with $10. That is your risk. This is your risk, is $10. Your risk is 10. Let's say as the market pull back, you want to sell from this region and you want to risk just $10 on your account. So this is your risk. So this is where you sell. This is your stop loss. Then you will now target 2 times of this one, which is now $20, will be your TP. It will now be your profit. So this is your take profit. So this is your sell. This is your sell point here, and you are risking $10, and this is your stop loss, and your target is $20. So as soon as the market move in your favor, it hits your TP, you are up with plus $20. So this is a risk to reward ratio of 1:2. But if it is a risk to reward ratio of 1:1, then as you are selling at this point here, what you'll be target is $10 as well. So immediately the market hit this point here. So that is a risk to reward of 1. This is a risk to reward of 1:1. So also, if you are using a risk to reward, if you want to use a risk to reward of 1:3, so now be that you are putting in $10 and you're targeting 3 times of it, which is 1, 2. So 1, 2, 3. That is to say that by the time it hits your CP, you'll be up with $30. So this is a risk to reward of 1:2, 1:3. So anytime you want to sell, you should always aim for a reward higher than your risk. The reason why it is important that once you are putting in your risk, your reward should be greater than your risk is because when, let's say for instance, you take 100 trades, out of these 100 trades, you lose 50 times. Let's say you are risking 1% of your account and you are having, let's say you have $100 as your account balance. You have $100 as your account balance and you are risking 1% of your account per trade. And your risk to reward ratio is 1:2. It's 1:2 risk to reward ratio. So on this $100, you take 100 trade. So out of this 100 trade, you lose, your losses, you lose 50 times. You lose 50 times. Then you also win 50 times. You lose 50 times, you win 50 times. So if you are using a risk to reward of 1:2, you know, anytime you are risking 1, you are targeting 2. That is to say that on this 50 win is going to be times 2 because of the 1:2. That is to say that it's going to be $100, but your loss is going to be 50 because you are risking 1. So if you take 1 out of this 100, now you'll now be up with plus $50 again. You have $100. You will take 100 trades, which is this 50 plus 50 is 100. So this is the total 100 trade. Then you lose 50 times. You lose 50 times during the period of trading, and you also win 50 times during that period of trading. So the 50 times that you lose is $50. You lose $50 in the market. Then the 50 times that you win, because you are using a risk to reward of 1:2, you are risking $1 to target $2. It's going to be 50 times 2, which will give you now $100. So by the time you take out the $50 which you have lost during the trade, when you minus it from this 100, you'll now be up with plus $50. So with a risk to reward of 1:2, you only need just 40% win rate and you are good. Then if you are using a 1:1 risk to reward ratio, at this point you'll be at break even, no loss, no profit. So if you have gained value from this video so far, please subscribe to my channel, like and comment. Thank you.